Starting with the basics, the market always moves in impulsive and corrective waves. This fractal nature of the market occurs due to the behavior of market participants. When market sentiment is bullish and traders are optimistic about a currency pair, they tend to buy it, leading to an impulsive move in one direction. However, as the price rises, some traders may start to feel that the currency is becoming overvalued and decide to take profits. Others might go short, which can trigger a pullback or correction. Conversely, when market sentiment is bearish and traders are pessimistic about a currency pair, they tend to sell it, leading to an impulsive move in the opposite direction. As the price falls, some traders may start to feel that the currency is becoming oversold and decide to buy it back, which can again trigger a retracement. Impulsive waves often push the price a greater distance with momentum, characterized by same-colored candles with large bodies. In contrast, corrections represent indecision on the chart, marked by mixed-color candles with small bodies and sideways wicks. Identifying the end of a pullback and the start of an impulsive move can be highly profitable, as it enables traders to capitalize on potential buying or selling opportunities in the market. Imagine we are in an uptrend, and we want to buy low and sell high to benefit from this bull market. We cannot open a buy position right now because the price is too high and may drop at any moment. So we need to wait for a correction to enter at a better price. The latest impulsive move has started from here and pushed higher all the way up to here. The correction will happen inside this range, and when the market gathers enough liquidity and buyers come into play, it will continue pushing higher again. If the price breaks below this level, it shows that the buyers are no longer in control, and the whole idea of an uptrend comes into question. It indicates significant bearish momentum and signals a possible reversal, except if it was a fake out and the market aimed to gather liquidity below this low and then take off. Now back to our correction range. Here's the question: where should we place our long position and enter the market? If we enter too early, the price might make a deeper pullback, and we end up losing even though our analysis was correct. On the other hand, if we wait too long, the price might start pushing higher without us entering, and we miss the trade. So the whole idea of trading with the dominant trend is to identify the end of the correction, which is the start of the next impulsive movement. But how are we supposed to do that? This is where Fibonacci retracement levels come into play. We always apply this tool from the start of the impulsive wave to the end because it helps us identify the correction range. If you apply this tool, you'll notice that a bunch of levels appear on the side. All of these important levels will act as support and reject the price when it reaches them. As it goes lower, it shows a deeper retracement. But for now, we only need the 50% retracement level. The area above the 50% retracement level is called the premium side of the range, and the area below is called the discount zone. The 50% level itself is called the equilibrium level. When the market sentiment is bullish and we have an uptrend, we want to buy in the discount zone for multiple reasons. Reason number 1: safer entry. The market loves to take out early buyers and use them as liquidity for future movements. So, waiting for the price to enter the discounted zone and then looking for signals to go long will instantly increase our win rate. Of course, every strategy has its downsides. In this case, we might miss some trades due to conservative trading, but a missed trade is always better than a losing one. Reason number 2: higher risk to reward ratio. We know that no matter where our entry is, the first target for the trade is this recent level of market structure. When the price taps into this level, some traders will close their positions or take some profits. Others might go long. This can create a correction or even reverse the direction. So this level is going to be our first target. If you enter in the discount zone, our risk to reward ratio would be too low. We always want our trade to have more than a 1-to-1 risk to reward ratio. That's why trading inside the premium zone will give us a higher risk to reward ratio and a rational trade. Reason number 3: safer stop. The best price level to set our stop loss to be safe from market fluctuations is below this swing low, because if the price breaks through this level, we will have a market structure shift, so the bulls will do their best to support this level. Therefore, the closer your stop is to this level, the safer it is. This was the third reason why we enter trades in the discount zone. Now let's have a recap in the bearish scenario. Imagine we are in a downtrend, and we want to sell high and buy low to benefit from this bear market. Right now, we need to wait for a correction to enter at a better price. The latest impulsive move has started from here and pushed lower all the way to here. The correction will happen inside this range, and when the market gathers enough liquidity and sellers come into play, it will continue pushing lower again. So we will apply the Fibonacci retracement tool and define the discount and premium zones. When the market sentiment is bearish and we have a downtrend, we want to sell inside the premium zone. Here is an important point. The impulsive moves can happen on a larger scale. For instance, consider this market structure in the 1-hour time frame. We have two turning points for the price. The market was in a short-term uptrend, a downtrend, and then an uptrend again. But if we look at the higher time frame, these three structures are considered a single movement. So, if we apply the Fibonacci retracement to the latest impulsive wave, we would have our discount and premium zones like this. So there is a higher chance for the price to enter the discount zone and then witness a reversal. In the next part of the video, we will show you how to combine this concept with other trading techniques to enter high-quality trades. But before we continue, now let me show you how to combine this with smart money concepts. Consider this structure as our higher time frame. When a change of character in the lower time frame appears, it signals a possible reversal. If the price contains enough liquidity and bullish momentum, the price will start pushing upwards. Otherwise, the price will continue to fall. This scenario may happen multiple times until the price gathers enough liquidity and momentum. Then the price will take off and show us the movements we want to see. So, a more conservative way of trading is to look for changes of character inside the discount zone. The best way to predict whether we are going to have a small correction or a large one is by observing the previous market behavior. In strong trends, we usually have small pullbacks with significant momentum. On the contrary, in trends with deep retracements, we expect a larger correction compared to strong markets. The same concept is valid with the optimal trading zones. In this example, if we look at the left-hand side, we can identify 3 fair value gap areas. When the price pulls back to these areas, they will act as support and push the price higher. But if we wanted to place a buy limit, these two would have been our choice. The difference between these 3 is that the higher one is located inside the premium side of the range, and the lower ones are inside the discount. We are only interested in buying inside the discount and selling inside the premium. This is a more conservative way to enter trades, resulting in a higher risk-to-reward ratio. It works best when the market is making deep retracements, but if we are witnessing an aggressive trend, buying in the premium side of the range can also be profitable. However, the important point here is that you're not going to win every single trade, even if you only take high-quality setups. Sometimes the market has different opinions. Even with a 30% win rate, you can be profitable as long as you have a solid risk management plan. You can't control the outcome of a single trade, but you can control the outcome with an overall good risk management plan. As long as you take high-quality setups and stick to your rules, you will be fine. But remember, before placing any trade with real money, you must do enough backtesting with your trading plan to obtain the performance and confidence needed to trade. Now let's look at some real chart examples and combine all the concepts we've discussed. Here we have the pound dollar on the 4-hour chart. There is a clear downtrend, and this is our recent bearish impulsive movement. Let's use the retracement tool to identify the premium and discount zones for the recent impulsive wave. One thing to remember about live trading is that waves are always expanding, and we never know where the movement will end. So if the wave keeps expanding, we simply adjust the retracement tool accordingly. Now that we have identified the zones, do we have any fair value gap and optimal trading area? If we look at the left-hand side, we can mark this gap between the candles. Since this is a very tiny zone to look for rejections, let's also mark the candle that created this fair value gap as our order block. This box is considered our optimal trading area, located inside the premium side of the range. The idea is to wait for the price to enter this zone, look for a change of character in the lower timeframes to confirm the reversal, and then go short. Another confirmation for this setup would be for the market to create equal highs, then sweep the liquidity above them, and then show a change of character. So, first, we wait for the price to enter our optimal trading area, then zoom into a lower time frame, which is the 1-hour chart, and observe the price action. Here on the 1-hour chart, we are looking for a price action signal indicating that this short-term uptrend is over, and that the price can continue to push lower in the higher time frame direction. So what do we have right now? We have a liquidity sweep pattern above these equal highs, which is an early reversal signal. It shows that this break was nothing more than a fake out and a liquidity run above these equal highs. Now that the price has collected the liquidity, it can continue pushing forward. This signal is later confirmed by breaking below this low, which is considered a change of character. Keep in mind that all of these signals have occurred inside the optimal trading area that we marked on the higher time frame. So the whole price action in the 1-hour chart suggests a market structure shift, and now it's time to place our short entry. But the question is, where should we place our order? Usually, in this case, we would look for fair value gaps and order blocks, but in the latest move, we do not have any imbalance in this time frame. So we can either apply the retracement tool and place our sell limit order at the beginning of the premium area, or we can zoom in one time frame lower to refine our entry point. Let's zoom into the 15-minute chart. In this time frame, we can see that we have an unmitigated fair value gap area near the swing high. If the price returns to this area, it would act as resistance and push the price downward. So let's open a short position, a spread size below the fair value gap, and set our stop above the swing high. Our first target would be this swing low. For a long-term target, we can track our profits until we reach the next important level in front of the price. This is how to apply the trailing technique correctly. Every time the price breaks below a level of market structure, we reposition our stop above the previous swing high to secure the profit. For example, take this green line as our stop loss. Right now, our stop is here. But every time the market breaks below a swing low, we would reposition our stop loss above the previous swing high.